The next topic in this chapter is capital structure. Capital structure refers to the mix of owners' funds, which is equity, and borrowed funds, which is debt. A business can have two sources of finance. It can be through owners' funds like equity share capital, preference share capital, reserves, and retained earnings. Or it can be through borrowed funds like through loans or through debentures, deposits from, not in, but deposits from banks or financial institutions, or through issue of debentures, or through deposits from the public. Financial leverage is calculated as either debt over equity, which is the ratio of debt to equity, or it can also be calculated as debt over debt plus equity, which is the proportion of debt in the total capital. Here we should also touch upon the concept of financial risk. In this context, financial risk simply means the risk that the business may not be able to meet its financial obligations or commitments. If the business does not generate enough returns or there is not enough cash flow, then there is a possibility that the business may not be able to pay interest on the loans that it has taken or repay the principal amount in time. In general, debt is riskier for the business because regular interest payments and principal repayments are obligatory. Equity is considered riskless for the business because payment of dividends or even returning the capital is not obligatory. Debt is also cheaper for the business. And as the financial leverage increases, the proportion of debt in the capital increases and the total cost of funds declines because of the increased use of cheaper debt. But as the debt increases, the financial risk for the business also increases since the business may be unable to pay the interest or repay the principal in time. As we have discussed, the capital structure of a company affects both the profitability and the financial risk. An optimal or ideal capital structure is the best mix of debt and equity that maximizes profits and maximizes shareholder wealth. And capital structure is decided on the basis of the opportunities available to the business, the possible returns that can be generated, and the cost of debt.